Hey, it's Paul Obrantz. Thank you for taking the time with me to really, invest in your future. In whether you're a first-time home buyer or this is not your first time buying a home. What we're going to cover here, I believe, is going to help everybody get a better understanding of, well, what it looks like to be a homeowner, the current market conditions, and just some common questions that people have asked me over the past 20 years. So let's go and get started. Let me just move my head here. And let's talk about what we're going to cover. So the first thing that we're going to cover is usually the first question that I get has to do with interest rates. So we're going to talk about some interest rate predictions. We're going to talk a little bit about, is there a crash coming and what's really going on? We're going to talk, of course, about the benefits of buying a home, some common misconceptions about pre-approvals, home buying process, the basics about getting pre-approved, do's and don'ts, and common questions. One thing I promise you is I'm going to give you a lot of information. You can always feel free to email me, give me a call if you have any questions, and we'll go from there. All right, so let's go ahead and start. I got to move myself again with predictions of where interest rates are headed. So I have here 8 predictions from the 8 leading research companies. Let's start off with the Mortgage Bankers Association. They're estimating that in Q4 of this year, rates will go as low as 5.9%. That's a pretty big drop from where they're at today. And in 4.9 by Q4 of 2024. Morningstar, on the other hand, is saying at the end of this year, it's going to go to about 6.25%, 5% in 2024, and all the way down to 4% in 2025. Goldman Sachs, 6.4% in 2023. And in 2024, they're saying about 5.9%. Excuse me. National Association of Realtors, 6.4% in 2023, 6%. 2024, Morgan Stanley is saying 6% in 2024. Moody's Analytics, 6.5% at the end of 2023, 6% in 2024, 5.5%. 2025. Can't believe it's going to be 2025. Realtor.com, 6.1% in 2024. And Fannie Mae, 6.6% at the end of Q4. 2023, it's going to go to about 5.9%, with an average of 6.1% in 2024. So I want you to remember that number because you're going to see that number again later on in this presentation. So let's jump. So what I'm trying to establish in that last couple of that last slide is that where rates are at today, it is, everyone seems to be on board that rates are going to decline, which leads a lot of people to determine, whether they should wait for interest rates to buy a house or not. So let's just keep that in mind. And let's move on to the next, as we're going to circle back to that concept. All right. Is a housing crash coming? Now, this is a really important part of this presentation because not only are people waiting for interest rates to go down, but people think that values are going to go down as well. This week, especially this week, I've seen a lot of news articles that are saying that the existing home sales are down, lowest level in years, and trying to create a little bit of frenzy. But if you dig a little bit deeper to see what's truly going on, I think you might see it in a different light. Yes, it is true that month over month, existing home sales, if you look right there, are down 2.2%, year over year, 16%. But check out the inventory. It's also down 14.6% year over year. So when we take a look at how fast homes are selling, on average, there's 3.3 months of supply of homes right now on the market. 4.6 is normal. What you need to know from that is that it's still a seller's market. It is not a buyer's market. Here's another one. Homes on market average 20 days. And then here's the thing, 74% of homes sold in less than 30 days. So if that house is priced right, it is going to sell fast with multiple offers. Now, you do have a few houses out there that you want to look at that have been on the market for 100+ days. Some sellers are very unrealistic, and you know what? This is not the market where their house is going to sell. Now, I'm not going to get into the construction numbers, the permits, the starts, the completions, but what I do want to highlight is, so we know there's not a lot of houses for sale. People don't want to move. And the reality is that people have so much equity and so low interest rates. Making a move for them has to be a necessity, not necessarily a luxury. So, for example, people that want a pool or maybe a different location, they're, in the past where they would make that move, they're not doing it right now because to do so would increase their monthly payment almost by double because interest rates have gone up so much. So what leads us to is, let's take a look at how many houses they're building. So I just want to, there's so much here I'm not telling you. I'm not telling you about existing home sales and all that stuff, but I think you're going to get to the point when I show you this next slide here. 1.452 million homes were started in 2000 or in 2023. But check this out. This is huge. New families looking to buy homes estimated to be 2.07 million in 2023. We already have a housing supply problem, and it's going to get worse. It is not going to get better. We have too many too many household formations that won't be met by the building of new homes. And so there's a reason for that. We're not going to go into it in this presentation, but I want to compare today's market. So we know there's higher interest rates today. We also know that the demand for housing is extremely high. The supply of homes out there aren't enough for people wanting to buy. We know that housing, new families formations called household formations are greater than housing being built. But what happened in 2008? Well, let's go take a look here. So let me just move my head here. So if you take a look over there, and you notice that in 2006, I want you to see that housing formations or new families looking for homes to buy is about half of what was being built, completions. Taking a look of the years leading up to 2008, you're going to see a trend. They just built so many houses back then, and there wasn't enough families to occupy them. So what started happening is people started buying investment properties with stated loans, terrible lending standards, no equity in the game. And that's when people started foreclosing. The exact opposite is happening in today's market. We don't have enough homes for people to buy, and they're discouraging from lending standards people buying investment properties and second homes. So when we take a look at today's market conditions, rates are up, values continue to rise, especially if the house is properly priced, and overbidding, again, on properly priced homes continues. So that leads to the question is, when is the best time to buy a house? I mean, is it now or should you wait? Well, let me give you something to think about here. So let's say, for example, let me just move me here real quick, is that we have a family that is looking to buy today at about 800,000. Rates are about 7.25%, and their total payment, principal and interest only, is going to be $4,365. Now, let's bring in next year's assumption from Fannie Mae that rates are going to go down to 5.9%. If this family wasn't able to buy a home this year because of the lack of supply of homes, next year when they're looking for that house at that same purchase price, but with a rate of 5.9, look how much their payment drops. It goes from $4,365 all the way down to $3,796. One observation I want to share, and it may not hold true, I don't know, but I want to share this with you. People are willing to go as high as they can to get a house today. Think about this. Values are still going up from 3 or 4 years ago when rates were in the twos. They're about double, almost not triple that, but they're about 2.5 times where they were, and people are still paying, they're still buying, and they're still overbidding. So take a look at this. So let's assume this client, this family, is willing to pay $4,365 per month for a home. With a new rate of 5.9%, that puts them at a purchase price not of $800,000, but of $920,000. Their purchasing power just went way up because interest rates went down. Now, I'm certainly not saying that if you bought a house today at 800,000 next year, when rates get to 5.9, your value is going to be 920. I don't really know. It might, but it might not. But what I am suggesting is that look at the purchasing power of people's buying power when rates go down. They are willing to use it. And I will tell you this, when rates go down, I would rather be a homeowner than somebody that is than a home buyer, someone looking to buy. Because when rates go down, more people are going to be qualified. There's going to be more buying power out there. And you may see houses being bid up again like they were a few years back with the pent-up demand that we have and the lack of supply. All right, there it is. It's a lot, isn't it? All right, let's go over it now. Let's say you are successful and you do own a home. Why would anybody want to buy a home other than creating a home for their family? Well, there's three reasons other than the family side, right, of buying a home. You have appreciation. Remember, each month when you make a payment, you're paying your equity, you're creating equity for yourself. It's like a forced savings account. Then also you have tax savings. Let's break these down a little bit one by one. So let's go ahead and take a look at appreciation. So what we're going to do here, if you look at this chart, this is for a property in San Francisco. So if you look at the graph legend there, it's right there. Historically in San Francisco, this appreciation averages about 6.36. Now, if you take a look, the forecasted appreciation over a 9-year period is going to be 6.73. That probably has a lot to do with the demand versus the supply. But if you bought a house today at 1.5 million, you put 20% down, that same house in 9 years using the forecasted column where they're dark blue is going to be worth $2.9 million. That is $1.2 million in cash, in equity that you've earned over that 9-year period. After you take into consider closing costs. That is absolutely huge. Now, I'm not, who knows what the future has, but I want you to notice that appreciation, even if it's single digit, you can create great wealth from single digit appreciation, given enough time in the right area. All right, so what we're going to do, we're going to go over a rent versus buy. So we're going to mix it up a little bit. We're going to say you bought a house for 1.1 million in San Francisco. The average forecasted appreciation is going to be 6%. We're going to take a look to see what it would look like if you were to rent versus buy. And we're going to take a look at how much amortization gain, appreciation gain you got, and how much amortization gain. Now remember, I'm going to explain that. Just hang in there. So let's go ahead and take a look at the red number, negative 208,000. What that's telling you is that if you were to rent a house at 1.1 million versus buy, from a cash flow perspective, you would pay about $208,000 less per, over that 9-year period. Now, there's a lot of assumptions here, right? We're going to get to one in a second here. This assumes that rates never go down and you're not able to refinance into a lower rate, because if rates go down to that 5.9% or even as crazy as 5% as some of these leading institutions are suggesting that may happen, that cash flow difference is going to drop huge. It's going to drop a lot. All right, let's go to the appreciation gain. So what it tells me is, now remember, this is not the same as the previous slide. The previous slide was 1.5. This is a $1.1 million house. In 9 years, you're going to gain $855,000 in appreciation. Over that same 9 years, you are going to pay your loan amount down by $112,000. Your total tax benefit, if you take a look at the bottom right-hand corner, over that 9-year period is going to be about $64,000. And that's above what you would get with a standard, with your standard deduction as of being a renter. So if you took a look that over those 9 years, the net gain from buying a home, which takes into consideration your cash flow, that negative 200,000, your amortization, right? The gain in equity, how much you pay down, and your tax benefit, you would have gained $704,367. That's not bad for a place. And by the way, this house that you bought, now that you turned it into a home, created a whole bunch of memories for you and ideally your family as well. All right, what's next here? So now that we've talked about why people buy, right? We talk about appreciation, the amortization, and the tax benefits. I want to talk to you a little bit about a lot of misconceptions out there that people have regarding interest rates. So doing this 20 years, these are some of the common things that people ask me or they just get wrong. The first one is the Fed rate versus the 30-year fixed rate. So now, over the last, it seems like a year now, the Feds are continually raising interest rates 0.25%. And a lot of people believe that their 30-year fixed rate mortgage is also going to go up 0.25%. Now, they are not the same thing. The Feds, what they control are short-term interest rates, home equity lines of credits. If you have one right now, you're feeling it. Credit cards, short-term loans such as auto loans, some student debt, etc. Now, they do not impact 30-year fixed rates directly. 30-year fixed rates, which we're going to get to, are traded on an open market in their bonds. So they can impact them, but that's not a direct relationship. So in other words, the Feds could raise, they could raise, I think it's like a 40% chance as we sit right now, short-term rates again in September by 0.25%. That does not mean 30-year fixed rates are going to go up 0.25%. All right, what's the other one here? So number 2, when you can lock a rate. Now, this is huge. I would say 9 out of 10 new buyers that I talk to that are not in a position to buy, their first question they always ask me is, what interest rate can you get me? Or they will compare me to somebody else that they spoke to a month ago saying, well, I'm already pre-approved for X rate. Well, the truth is you're not. So rates change on a daily basis, which we're going to get to. The first time any lender can lock in your interest rate is once you get into contract. Once you're into contract, that is ideally the time. That is the time that you will be able to lock your interest rate. Now, there's programs out there such as Lock While You Shop. Those really don't exist anymore. It was more so in the past. Now they're too costly to utilize and they're just not worth it. So 99.9% of the time, you are not locked in the interest rate. And if you were, you would definitely know it. And that is a big misconception that first-time home buyers have. When to shop for a rate? I kind of just answered that indirectly. The best time to shop for a rate is when you get into contract because people can actually perform at that time. Now, a lot of people won't agree with me because you should, right, be focusing on closing a loan. I totally agree with that. But here's my philosophy with my clients. When I get you pre-approved, it is all about educating. Not only am I going to educate you on the loan process, what fees are, all that stuff, I'm going to teach you how to shop for interest rates and things to look out. I've seen it too many times where people get taken advantage by somebody offering a lower rate only to hide a fee in there of $10,000 that just does not make sense. It's happening way too often, especially as rates get higher. So I will make sure that you are an expert at looking at interest rates, because what you'll find is that my rates are right there. The people that are really against that are people with higher interest rates. They're scared that you're going to shop and notice that their rate is way too high. Now, let's talk about the extent. You should only shop for about a day or two because you really do need to focus on getting your loan closed and approved. So that should not be a long process. All right. How rates affect your approval. So it's very common for lenders to say, you're pre-approved to a purchase price up to 500. Well, let's just say here up to 1.1 million. But the truth is, and what you're going to find out in a future slide, you're really not pre-approved to a purchase price. You're pre-approved to a monthly payment. So let's say in this scenario that you're looking at, the max payment that this family could qualify for is $5,562. If they try to go higher, that's going to put their payment to a position where their debt to income ratios will be too high and their loan can't get pre-approved. Now, what if rates decline? How's that going to affect their pre-approval? Well, if rates go from 6.5% to, let's just say, 5%, to get that same payment of $5,562, now they're pre-approved. Their purchasing power just went from 1.1 to 1.295. Now you're going to have a little bit more down payment, and you have to make sure that works. But let's just assume that they do. That's how that's going to affect your pre-approvals when rates go down. But what about if rates go up, right? So if rates go up, let's just say 7.5%, that $1.1 million purchase price that you were pre-approved to goes all the way down to $994,330. So it's really important to understand and to kept aware of where interest rates are at, because if you're shopping at the top of your pre-approve or your budget, if rates go up or down, that's going to impact your bottom line. I think it's the final misconception about interest rates is that rates don't change that often. That is not true. So we've talked a little bit about recently, about 5 minutes ago, how rates are bonds. Bonds are traded on a daily basis. And what you're looking at here is a picture from MBS Highway. We monitor the rates on an hourly basis. Rates can flip just like that from good to bad, and you have to work with somebody that monitors the rates, because if they're only looking at it one time per day in a 24-hour period in this market, I've seen rates jump up 0.25%. And if you're buying a house at 1.5 million, 1.1 million, believe me, 0.25%, you are going to feel it in your payment. Not only is your payment going to go up, but just like we just discussed, if you were at your max pre-approval, you may not even qualify anymore. That's really, really important. So let's finish up this conversation about interest rates, and let's talk about how to put yourself in a position to get the best rate. One thing I will tell you, and I'm going to bring up in a second with the hopes and dreams conversation, is that if you're thinking of buying 2 years from now, a year from now, 6 months from now, the time to get pre-approved is today, because of what we're going to talk about right now. Putting yourself in the best position, let's start with number one. That is going to be to have a great FICO score. We're going to talk a little bit about that in a second, but I'm telling you, a lot of people have misconceptions of what their FICO score is, what the number is, and you may be in a position that if you wait to get pre-approved once you find your dream house, if your FICO score is not where you think it is, you're going to pay a higher interest rate. That's just how it is, or may not qualify for a certain loan program. Down payment, the more down, generally speaking, the more down you put down, the better interest rate you have. That's speaking for conventional and jumbo, not necessarily with FHA, but it's something that you really need to consider, is that down payment will impact interest rate under certain programs. The type of house, right? Whether you buy a condo, a townhouse, or a single family residence, some of those are going to have different interest rates. Now, one of the biggest mistakes people make is with a condo, especially if they're working with out-of-state lenders or they're not communicating with their lender what type of house that they're looking at. Your rate, some lenders' rates will go up by 1 point or about 1/4 to 0.3% if by making the change from a single family residence to a condo. So how would you know if you're looking at a condo versus a PUD? The truth is you really don't. To be sure, you have to reach out to your loan officer. Now, if they don't understand what you're asking, you might want to change loan officers, because that's a big deal, because you're ultimately going to pay more for your loan, even if you think it's their mistake. You need to communicate that with them. Give them an address. It's really easy to look up. If you have any more questions on that, let me know. But that is huge. I think that catches more home buyers working with inexperienced loan officers than any other type of situation. Your intent. Are you going to live in it? Are you going to rent it? Are you going to be a second home? Let's talk about second homes and investment properties. Typically in the past, owner-occupied homes had the same interest rates as second homes, or vice versa. Second homes had the same interest rates as owner-occupied homes. I think I started off by saying that, they're trying to limit, because of the demand or supply issue, people from buying second homes. Because what I've found is that it's completely changed. Second homes now have the same interest rates as investment properties, which is crazy. It's totally different. And what you're going to find with second homes and with investment homes, that on a whole, you're going to need to put 25% down. Otherwise, you're going to pay a ton of points. So 25% down, that's going to be huge. The best way, here's a hint tip. The best way to create wealth through buying multiple properties is to, for your first home, buy a house that you're going to rent out, live in it for a year. Then you can buy the next house and live in it for just 5% down. We can talk more about that. It's a great strategy. Reserves. Some of the best programs out there, rate programs, need reserves. And what reserves are, they're cash after you close, how much you have left in the bank, 401k accounts. Typically, like if they say 12 months reserves, what they're really saying is that we need 12 months of payments in your account after we close. The type of loan, whether it be FHA, VA, conventional, all these or jumbo, they all have different rate types. And so depending on which ones you're shopping with could really impact what rate. Here's the biggest trap that I see a lot of first-time home buyers, inexperienced home buyers get when they are shopping for rates. You'll have one lender that is quoting them FHA, which typically has lower interest rates, but it has so much higher of a cost. This is the one area versus conventional. I'll get back to that. Versus conventional, which has a higher interest rate. You always want to go conventional, given typically you want to go conventional because it's a lot cheaper cost of loan, and the mortgage insurance will go away, where FHA, unless you put 10% down, that mortgage insurance will never go away. So what lenders know is that people are very rate conscious. So they're giving them FHA loans, not conventional. That's something you don't want to fall, that trap you don't want to fall into. So the best thing you do, hopes and dreams. Let's talk about hopes and dreams meeting. So I've been doing this for 20 years. And what I realize is that people, they shop, they do a lot of research online. And I would say about 80% of the information they gather is incorrect, whether it be from payments, type of loan they think they should be in because of interest rates, where all this, the amount of down payment, the amount of reserves. So what we created, what's called a hopes and dreams conversation, where in this conversation, we do not talk about credit pulls. We do not talk about applications. We literally spend about 15 to 20 minutes answering your questions. And I can give you from a high level overview pre-approval process about where you would qualify for, what your payments would be, and whether or not you would even want to explore getting pre-approved. So I highly recommend doing that hopes and dreams conversation. It's always better to know than to wonder. Trust me on that. All right, let's go over the home buying process. Really, in a nutshell, this is oversimplifying it, but the first step is you really do want to find a lender. You get pre-approved and really start that mortgage planning. For my process, the getting pre-approved is not a commitment for a loan. It's still an educational process. It's a 3-step process. I'll send you a link. You'll fill out your application. That will move you into the second step, where I will collect all of your documentation and get you fully pre-approved, narrow down the best choices of loan products that best fit you, which leads us into the third stage. That's the mortgage planning. Now, during this mortgage planning, we're going to go over everything: down payment, fees, property taxes. We're going to go over so much, and you're going to have your own website for you that you'll always be able to look at. That my goal is to be able to have you almost want to become a loan officer, that you have enough knowledge to be a loan officer. Now, after you're pre-approved over a 10-week period, every Monday I send out an insights to interest rates, weekly insights to interest rates, talk about what happened, what's going to happen. And then we have a 10-week video series that breaks down what points are, what you should do in a situation where you can you can negotiate for a credit. Should you get a price reduction or get your interest rate paid down? My goal is to make sure that you are fully armed with the facts and you can focus on getting that house closed. Step 2, once you're fully pre-approved, you know what your budget is, you have your survival number, you're confident in the interest rate, you have to start shopping for a home. A real estate agent in this market has never been more important. If you think you just going to work with your sister's best friend's sister, that's a real estate agent that has zero experience, you're going to be looking for a long time. Otherwise, you're going to have to overpay a lot because they don't know how to negotiate. This is a negotiating market, and people need to know that you're going to close. They need to have certainty in the deal, because a lot of times your transaction is going to affect their transaction, which is going to affect their transaction, and all the way down the line. The last thing people want to do is to, start working with people that may not close. Step 3, once you located that house, you're going to make an offer. Once your offer is accepted, that's when we're going to start looking at locking your interest rate. You're going to get a home inspection. We're going to get insurance. Insurance is a big issue lately in California. So you want to make sure right away that you know what that premium is going to be. In some areas, where homeowners insurance used to be like $200 a month, now they go up to about $300 to $400. So it's a budget moving factor. We'll get your appraisal done. Then step 4, we'll get you closed, get into underwriting, get you a closing agent, get you fully get you everything. That's a super, super oversimplification of what it looks like to buy a house. In fact, I don't even know if I like that slide, to be honest with you. But let's move on. All right. How do I qualify for a mortgage? To really keep it at a high level overview, lenders look at 3 things: your credit score, your capital or your assets, and your capacity to pay. Now, it's really important to understand that how you calculate your income is not how we're going to calculate our income. Since 2008, we have made a deal with the government that all lenders are just going to follow a checklist, and that checklist is going to be followed to a T. That's why some people think it's tedious on the documents that they need to collect. But in order for them to check all those boxes and deliver a loan to Fannie and Freddie Mac that's going to be sellable and that they're going to buy, we have to ensure that all checklists are checked. So let's go ahead and start with credit. Now, a couple things about credit. Let me just actually move this over here. Over here, there's a circle with what your credit score is made up of: 35% payment history, utilization, length, new credit mix, right? Here's a couple of highlights that I want to share with you. What is a credit score, right? That's just a lender's way of showing your ability to repay. How responsible are you in repaying your debts? It's very important because without that, they wouldn't know if you're a good risk. We talked about what determines your credit score, but let me talk about a few things. The biggest mistake people make is they don't have credit. No credit is bad credit, period. If you don't have any credit, you better go out there and get yourself a credit card, but we should probably talk and I'll share with you how to do that. But if you don't have a track record, you are not going to get a loan. It's very challenging from that respect. Also, another question that comes up is, when I'm talking with people during our initial hopes and dreams conversation, they'll give me what their FICO score is from their bank, like that free FICO score. And it's usually a lot higher than what credit report we pull. Now, you didn't know this, but each type of institution, whether it be car loans, home loans, credit cards, they have their own weights in terms of what they lean on to create a credit score. So they're all going to be different, number one. Number two is every time you use your credit card, your usage changes or you pay off your debt. So your credit card, just like interest rate, isn't a set number. You don't have an 800 FICO score. You don't have a 700 FICO score. What you have is a FICO score that continually changes depending on how you use your score or your debt and when you pay your debt off and what types of debt that you have. Let's go ahead and talk about the capacity, the ability to repay a debt. Bottom line, we're going to keep this super simple here. We have to make sure that there's enough income to cover all of your debts. So the general rule is if you look at all your monthly obligations that are on your credit report and your housing, that total cannot exceed 50% of your gross income. If it does, they're not going to give you a loan. Assets. So down payment. Down payment usually comes from one of 5 sources. Right? It's going to come from your checking savings, your 401k, or your retirement, a gift from a family member if you own a home, the proceeds from the sale of that home, or down payment assistance programs. Now, the minimum down payment requirements are going to depending on what type of loan you have. So for conventional, if you're a first-time home buyer, the minimum down payment is going to be 3%. If you're not a first-time home buyer, And with conventional, it is 5%. FHA is 3.5%. VA 0%. And jumbo is 10%. So let's kind of start wrapping this up here with some do's or don'ts. These are the common things that have happened over the past that have either prevented people from buying a house, even after they got pre-approved. Do pay your bills on time. If you get a credit late or if you get a delinquency after we get you pre-approved, your pre-approved is no good. Do continue to use your credit card as you normally would. Do disclose all of your income and debts. My friends, we will always find out your debts, your income, everything. Trust me, we have ways with the IRS. They do these MERS. It's crazy what they can find out about people. And here's the thing, from a lender perspective, if you don't share everything with me, I can't protect if something were to come up, whereas it may not be an issue, but once it becomes a red flag, it's really hard to get past that with underwriters. Do provide documentation of all financial information. We talked about the checklist. You know, one of the biggest things is like with tax returns, we need all your pages from the federal 1040s. Bank statements, if it says page 5 of 5, we need all 5 pages, even if it's blank. You know, we need accurate, current accurate documentation. Do be upfront about your credit score. You know, it's okay if it's bad. We have great programs called Coaching to Success that if you're in a rut, we've helped many home buyers just like you improve their credit score and that are now homeowners. And always do contact if you have any questions on what you should do. I can't tell you, please, my line's always open to my clients I have pre-approved. All right, don'ts. Don't quit your job. If you're going to quit your job, please tell me beforehand. Don't move. Don't apply for new credit or loans of any kind, especially if you're going to co-sign with somebody. Don't co-sign or become a co-borrower on any other loans. Don't pay off debts, collections, or charge-offs unless advised by me. Here's the deal with paying off collections or charge-offs. Believe it or not, if you have a collection or charge-off on your credit report and you pay it off, it'll be treated like a brand new collection or charge-off, and it's going to tank your score. So don't do that. It's a bad, bad, bad thing. Don't make any major changes to your asset structure. Great intentions. People have like 4 accounts. They're going to bring down payment in. So they start moving everything into one account. That's going to create a lot of paperwork for you. Just don't move anything. We can definitely help you with that. And don't make any cash deposits. Believe it or not, even though we use the cash bag before to talk about assets, cash is no good when it comes to loans. No good. No good. All right, so I'm going to wrap this up with some frequently asked questions. Here's a great one. Will pulling my credit hurt my credit score? It will impact your credit score from 0 to 3 points only, and you have a 30 to 45 day window. I use 30, but I've heard 45 window where you can have your credit pulled by multiple lenders, right? And it'll only be treated as one inquiry. Now, we will still show up on your credit report, but it'll be only one inquiry. Why is my credit score different on Credit Karma? Credit Karma uses a Vantage, not credit. Totally, completely different system. Is there prepayment penalties? There are not prepayment penalties on conventional, VA, FHA, or jumbo loans. Now, non-QM loans, such as bank statements, dated loans, and such like that, do have prepayment penalties. Is it safe to buy a short sale or a foreclosure? Absolutely, but here's the thing. If a house forecloses or short sales, they're going to go on the open market and they're going to pay top dollar. So you're not getting the deals unless you have cash to buy an auction house. Is it safe to buy a fixer-upper? It could be, but I don't know your situation. You have to make sure you have the cost to repair it and get in a place to be livable and lendable. What I've found is that buying a house to fix it up right now does not necessarily make it cheaper way to buy a home. If the house appraises for less than the purchase price, what do I do? So it depends how much you're putting down. Each situation. So the rule is, from a loan perspective, we have to base everything on the lesser of the purchase price or the appraised value. The contract you have with the selling agent is going to be the purchase price. So you may have to bring in more funds, but as long as you're putting more than 5% down, there's a chance that you will not have to bring in more funds. But if you have a situation about that, let me know. I'd be happy to walk you through it. Can I back out of my purchase contract? This is an excellent contract. So when you put an offer in, usually you have loan contingencies and appraisal contingencies. You also have inspection and I think something else from the seller, from the realtor side. As long as you have, from my understanding, Your loan or appraisal, your loan and appraisal contingency is still in place. Your loan, you can back out and get your deposit back. So there it is. So here's the thing. I hope you enjoyed this, and I hope I gave you an understanding of, we do believe that interest rates are going to start going down. The real issue with today's market is, the supply of houses, which is totally different from 2008. And there is no crash coming until more houses are built that can match or exceed the demand for housing. Right now could be the best time to buy a house, even if their interest rates are the highest they've been in, over a decade. I think it's over a decade. It's pretty crazy, because what it may be creating is a lull of people that could buy. They're just kind of scared of not knowing what to do. Because as we walk through that exercise, I think that when rates get down to that 5.9% if Fannie Mae is correct, when that happens, I'd rather be a homeowner than a home buyer. We talked about some misconceptions with interest rate. The first thing you're doing as a new home buyer is not shopping for rates, but it's getting pre-approved and getting educated. The time when to shop for interest rates is once you get into contract. Excuse me. We took a look at the three legs, or the three pieces of the triangle to get approved for a loan. You have your credit, you have your assets, or your credit, your assets, and your income. We talked about frequently asked questions and do's and don'ts. And we also talked about hopes and dreams. If you want to schedule a hopes and dreams conversation, please reach out. Would love to help you with that. Otherwise, thank you for your time, and I hope you have a wonderful day. Take care.